Ladies and gentlemen, good evening. This is Christopher Aaron. It is late in the evening on May 2nd, 2018, and I do thank you for being here. I've been asked the question several times recently, why am I focused on this sector, on the precious metals specifically? And there are two primary reasons why I'm focused on this sector, two primary categories. I want to touch on that briefly so you can understand why I'm here, why I'm doing what I'm doing here. One category are personal reasons, and I'm not going to get into this in too much depth right now. I've hinted on this in the past, but the short of it is that in my time overseas in Iraq and Afghanistan in the last decade, I observed a number of things that I did not agree with. And that is why I chose to leave that career field, that path. And I transitioned. And specifically, some of the things that I observed had to do with waste. Waste of resources, waste of life. And in my digging and my research on the subject, I came to the conclusion that a significant portion of the reason why there is so much waste in the world at this point is because the currencies have been debased and debacked by gold and silver. And that this is a significant part of the reason why we see some of the excesses that we see in the world today that are leading to pain and suffering for many. So these personal reasons, as I said, I may get into those more, some of the specifics in the future. For now, I wanted to focus on the valuation reasons why I'm here, why I'm focusing on this. Let us begin. The math behind it. What can we quantify a bit more? As we look at the ongoing consolidation here in gold between 1303 on the low side and 1369, we have targets for this consolidation that will be equal to that amplitude depending on the direction that the consolidation breaks. But as of this point, it's a continued consolidation. We will be looking for hints from the gold mining complex and hints from the gold to silver ratio and hints from the commodity index, the CRB index, to attempt to gauge which direction this is going to break for gold. When we look at silver, not making a new low for the move today, so a slight improvement today in the gold to silver ratio. That's a good sign to see, but we want to see silver continuing to transition to a leadership role. It is still not at that point, but it's trying to. We can see hints of that on the chart of the gold to silver ratio. These little blips lower where silver is trying to establish a leadership role at this time. It's attempting that. It has not solidified it yet. Why am I focused on this sector? For the most part, it has to do, although I am an owner and an accumulator of the physical metals, I believe from my standpoint, the physical metals are savings. That's how I save my money. I do not save my money except for a month or two of expenses here or there. I do not save my money in a bank account. I save my money in physical metals. But that said, when we are looking at another subcomponent of this, the gold mining sector, this is where a significant portion of my focus is at this point. I'm going to explain to you why. There are two primary reasons why. The gold miners are the cheapest that they have ever been in the history of record keeping across two different valuation metrics. We'll get into the gold miner math in just a moment, but this is the valuation potential here. We're looking at the gold miners relative to the rest of the U.S. economy. In other words, the XAU gold mining index to the S&P 500 from 1984 to the present. And we see the current valuation right down here at 0.031. Now, for perspective, in 2011, at the peak for gold and silver, this valuation got to 0.02. And I know, so it seems like, okay, what's the difference between these numbers here? This would be an eightfold move, 700% or eightfold, just to get back to the levels that we were talking about from the 2011 peak. And to make this even more dramatic, when we look back into the early 1980s, we are talking about, for the precious metals to get to where they were in the early 1980s, we would be talking about a 3,200% increase in the average gold miner, or a 97% drop in the US stock market. Most likely, it will be some combination of these two. The important point to remember here is this ratio. When you're looking at a ratio of real assets, we're talking about a sum of the gold miners and a sum of the largest companies in the United States. When you have a ratio between real asset classes, this cannot go to zero. That would imply that the sum of the gold miners would be worth zero. This has never happened, and it never will happen. This ratio cannot go to zero, yet it is the closest that it has ever been to zero. This valuation here. It's equal to the bottom in 2001. And I'm just telling you from my own experience, having the opportunity to buy some of the miners here in 2008 during the crash. Some of these miners went up 3, 4, 5, 600% over the next 3 years in just this move right here. So we're talking about an even lower valuation for the sector, nowhere near a long-term peak when we look at the gold miners relative to the U.S. economy. On a reward to risk basis, this is a highly lucrative setup. The other major valuation component, ironically, and although I said once again that I am an accumulator of the physical metal, when we look at the relative valuation actually between the gold miners and the physical price of gold itself, this is also just rounding off the lowest valuation that has ever been seen. We have 25 years of normal historic valuation ranges for the gold miners relative to gold itself. In this range here, we could take a mean of just above 0.27 on the ratio. Right now, we are just above 0.06. So something happened here in 2008, in the crash of 2008, as capital froze for mining projects and people became less interested in capital-intensive development. The peak in gold happening a couple years later, and then the washout that we've seen over the last few years, and the minor attempt at a rebound here. So what I'm saying is, in this ratio, even though I do think that gold will be moving higher over the next year and into the future, on a reward to risk basis, this ratio, for it to get back, let's say, into the upper ranges of a known valuation range between the mining sector and gold itself, we would be talking about a 320% increase in the average gold miner, or, this is the hard part, actually a 77% drop in the gold price, or some combination of the two. This is the known historic valuation here between gold miners and gold itself. There should be a normal relationship. We are living through some sort of an anomaly at this point of this relationship that is completely out of whack based on where it has been for the broad history of the relationship between these two intrinsically related things. Gold miners, this is gold in the ground, and gold above ground. These should be related. We are just off the lowest valuation ever, which calls for a radical increase in the valuation in the gold miners relative to the price of gold over the next decade coming up. So we are watching this consolidation ongoing in gold. A break below 1303 is going to see a quick move to the downside, and then there will be a key support level coming up around 1,237. Quite a bit lower from here, but if gold were to break lower, that is the figure that I'm watching quite closely, and then we'll be watching how does silver perform if that happens. If gold holds here at 1303 and continues to round up, then we are looking at a target in the low 1400s within the next couple of months. And again, we want to see silver leveraging the gains in gold. That is the big point for the next several months. either leveraging higher or not falling as much as gold if gold does decline. So we want to see that gold to silver ratio coming down no matter what happens over the next several months to the actual nominal prices. That is the big picture. As I said, once again, I am here for both personal and mathematical based reasons. On the math side of things, on the research side of things, we do publish a premium service that comes out at least once per week. Last week was a special video that we did. We covered some myths that are currently being thrown around in the silver market about how silver performs during a stock market crash, and also how silver is structured based on the COT, or the Commitment of Traders report. There's a lot of faulty analysis being discussed out there at this point on those two things. So we covered that in depth in a video like this. It was about an hour and 10 minutes long last week. That is available for subscribers. We also covered the exact gold and silver miners that we are investing in here, as well as all the research to back that up. If you're new to the sector or thinking about switching your strategy to some extent, please know that I work with individuals on a one-on-one basis. And I work all the way with advanced traders who are trading futures and options to talk about some support and resistance levels that they might cover. I work with individuals who are looking to diversify, who would like our research on their individual gold miners that they own. But also know that if you're completely new to the sector, there's no question that's too new. I work with individuals, and I don't take funds from any of the companies that I work with or profile. This is entirely an individual subscriber based endeavor here. So if you have an issue that you would like to discuss with me, anything about gold and silver, please know you can find information on that on the website, and I look forward to working with you. So once again, I am here myself personally for, as I said, for these reasons that have to do with things that I experienced in my own life going back several years, things that made me wake up to some extent to what was happening actually in the monetary system, in the financial system, in the political system, and how gold and silver play a fundamental role in this. I am also here for the mathematical and the valuation-based reasons. It just so happens that the time that we're living through right now, both of those data points, both of those sets of data really align at this point. That said, nothing is guaranteed in life, so please don't invest next month's rent payment, because if we are wrong for any reason, you want to make sure that you can survive through. If this market takes longer than we would expect, you want to make sure that you position yourself so that you're ready for when the next upswing actually happens. Thank you very much, and I will see you this time next week.